Funds to attract, oh wow. That's better. Don't worry, I won't start from the beginning. Funds to attract and retain exceptional faculty, funds to bring distinguished visitors to campus, such as Jim, and last but not least, outreach to the public as exemplified by today's talk, our first annual State of the Economy address. We have two other outreach events upcoming this semester. Next week, in this very room, at this very same time, Professor Kenneth Rogoff of Harvard University is going to talk about, is this the end of central bank independence? The central bank in this title refers to non-governmental organizations such as the Federal Reserve System in the US or the European Central Bank in Europe. Broad motivation for something like this. It was illustrated, as many of you know, President Trump has been putting pressure on the Federal Reserve System to lower interest rates. Professor Rogoff's talk is not going to be a reaction to a day-to-day event from President Trump or anything else. It's going to be a cross-country and historical perspective on central bank independence and the general question of the costs and benefits of maintaining central bank independence from political pressure. It'll be great. It'll be great. Hope you make it. Second event is a day-long symposium on American economic challenges to be held Friday, October 11th in Gordon Commons here on campus. This is a day-long symposium with a set of speakers that come from not only academia, but the private sector and senior economic policy making positions. It's going to address a range of issues, including, among others, healthcare, higher education, trade with China, and other things. And this too will be great. It'll be fantastic. For more details, I have the URL up there, and we hope to see you at both of those. All right, a few housekeeping details, including question and answer. The talk plus question and answer will take about an hour, so we expect to end around 5:30. All of you are invited to an informal reception to be held right outside there at 5:30, where you get a chance to perhaps speak one-on-one with our speaker, any of the large number of econ faculty that are here, or of course among yourselves. In terms of questions and answers, our ground rules are that we ask that you not interrupt the speaker with your questions. When you sat down, there should have been a little piece of paper that says JPGI on it. As Jim is speaking, if a question occurs to you, write it down. In due course, as he's wrapping up, pass it to the end of the aisle, and we'll have some students picking up those questions and reading them to Jim. All right, finally, Professor James D. Hamilton is the Robert F. Engel Endowed Chair in Economics at the University of California, San Diego. Not me. He has done influential and widely cited research in a remarkable range of topics in economics, including econometrics, monetary policy, business cycles, and energy markets. He's won awards from the International Institute of Forecasters and the International Association for Energy Economics. He's a fellow of the Econometric Society. He's been a visiting scholar at the Federal Reserve Board in a number of branches of the Federal Reserve System. He's won no fewer than 6 teaching awards from the University of California, San Diego Economics Department. He is the founder of the popular economics blog, Econ Browsers. That is only a partial listing of Jim's accomplishments, but in the interest of time, I'll stop here and finally let him speak. So please join me in welcoming Jim Hamilton.
Hey, thank you, Ken, for those kind words, and it's certainly an honor to be giving this JPGI lecture, as the insiders refer to it, at one of America's great universities. Let me begin with this graph. It's a plot of the unemployment rate in the United States going back about 70 years. It's a measure of the number of Americans who say they're actively looking for work and can't find it. It's reported here as a percentage of the labor force, and you'll see it looks kind of like a picture of a mountain range, where every now and then, for some reason, the number of unemployed shoots way up where within a year or so, we're talking about maybe 10% of the workforce trying to find jobs and can't. And economists often summarize that phenomena by saying, well, we're going through a particular episode, an economic recession, and I've indicated the dates of historical U.S. recessions here with shaded areas. We could talk about exactly where those dates are determined, but roughly speaking, that's the date at which this rapid acceleration up in unemployment begins, and we say the recession is over when unemployment starts to come back down. And figuring out when we're going to have the next of these recessions is a very important question, for example, for any students in the room. If you're expecting to graduate a year or 2 years from now, if the economy's in a recession at that point, you may have a much harder time finding a job or finding the job you want. Matters not just to the students here. Here's another graph. This is the value of stocks as measured by the S&P 500. It's the real value, so this takes into account inflation. And this is measured on a log scale, which means when that number goes down by 10 points, say down from 90 to 80, that roughly corresponds to a 10% decrease in the real value of stocks. And again, we've got the recessions here. And if you look at that graph, you can see that in the next recession, you might well expect to lose 20% of the money you've saved up in stocks within the course of a year. So any of you that are saving for retirement or why did that happen? Was I talking too long on that slide? Would be interested in that, oh, there we are, knowing when the next recession is. And, oh, I see, it's just mine that's blank. Well, that's interesting. Let me give a third example. Let's say maybe you're not worried about your job security, maybe you're not worried about retirement. Let's take, for example, tenured professors at the University of Wisconsin. This is a plot of the tax revenues collected by the state of Wisconsin annually, and you'll see usually that goes up, but not always. There are a couple of occasions when the tax revenues fell significantly. What are those occasions? Well, they happen to be these recessions we're talking about. Because when people aren't working, they don't pay as much taxes. When people are losing money in stocks instead of getting capital gains, we don't collect as much taxes. So this means less money for anything that the state of Wisconsin supports. So I think it's a fair guess that for everybody in this room, this topic of when's the next recession coming could be pretty important. We go back to this graph I started off with, the unemployment rate. Right now, the unemployment rate is extremely low, about as low as it gets, frankly, historically. So no question, right now we are not in a recession, but is one coming soon? That's the topic of my talk today. And if you pay any attention to the financial press, you'll know there are a lot of other people talking about this same question right now. So here are some headlines recently from Fox Business. Is a U.S. recession coming? Yield curve flashes dire warning. Or if you don't like Fox, take CNBC. The yield curve everyone's worried about is inches away from flashing a recession signal. Or Bloomberg, yield curve blares lowest U.S. recession warning since 2007. So what is this yield curve? And what exactly is this loud warning that it's blaring? That's going to be where I begin, going into the details of what is causing these seeming alarming statements, look at exactly what the facts are. And then once we've looked at that, I'll be talking about some other indicators for whether or not they're corroborating these signals. So what is the yield curve and what's the warning? Well, really you can summarize it with just two numbers. And the two numbers are two different interest rates. And I've reported what those interest rates were on average last month here. One interest rate is the interest rate you could earn on a one-year Treasury security. So if you lend money to the U.S. government in the form of buying a Treasury security, you get your money back in a year plus interest. And that interest rate has been around 1.77%. That would be your return if you lent to the U.S. Treasury for 1 year. Or another kind of security you could buy is a 10-year bond. In this case, you're loaning to the U.S. Treasury for 10 years. You won't get your money back for 10 years, but you'll get some coupon payment each year now until 10 years. And we can calculate what's going to be your average interest you'd earn each year on a 10-year bond. And that number right now is 1.63%. So those are the two numbers. And what they say is that right now, you'd actually earn a little higher return this year if you bought a 1-year bond compared to the average return you'd expect each year if you buy a 10-year bond. And when that 1-year bond yield is above the 10-year yield, that's what people are talking about when they say the yield curve is inverted. And the reason they talk about that is this isn't the way we usually see these numbers. Usually, the 10-year rate is above the short-term rate. Right now, that usual relation is inverted. So let's take a closer look at these numbers. Here's a plot of those two interest rates in the top panel every month going back to 1953. The 1-year rate is plotted in black. The 10-year rate is plotted in blue. And you'll see that tendency. Usually the blue, the 10-year rate, is a bit above the black, the 1-year rate. Sometimes it's a lot above, sometimes it's a little above. It's kind of unusual to be in the situation we're in right now, where that 10-year rate is actually below the 1-year rate. Now you can see that relation a little more clearly in that bottom panel, which is labeled the spread. That's just the difference. The value of that bottom panel is just the difference between the 10-year rate in any given month and what the 1-year rate was in that month. It's called the spread, and you can see that number is usually positive. Usually you earn a higher interest rate on the 10-year bond, sometimes 1% more per year, sometimes 2% more per year. Sometimes you earn a little more on the 1-year bond when that number becomes negative. And if you look at the times when that number became negative and relate them to those gray recession bars we talk about, you might see something that's a source of concern. Namely, before each one of those historical recessions, we got into this episode where the yield curve was inverted. Usually the long rate is higher than the short rate. Right now it's lower than the short rate. And historically, when it's been lower than the short rate, that was often something that happened a little before a recession. So that's what the dire warning is. That's what's in the data, and that's where we are now. So let's go into that a little more detail. Why might that be? One thing you can just say, well, I see it in the data. Here it is again now. It causes me to be concerned, and that's a reasonable way to proceed. But let's see if we can understand what some of the forces might be that would cause the yield curve occasionally to be inverted. And the first place we start whenever we're teaching a class about the relation between different interest rates is what's called the expectations hypothesis of the term structure. And this is one very simple idea of how the 10-year interest rate should be related to the 1-year interest rate. And according to the expectations hypothesis, the 10-year rate at any given point in time should equal the average of the expected 1-year rate over each of the next 10 years. And the argument for that is if it didn't equal, if the 10-year rate was higher than the average expected short rate over the next 10 years, well, you're better off having your money in the short-term bond rather than the long-term bond. You might buy that short-term bond and bid the interest rate on it, bid the price of the 10-year is above the 1-year. The 10-year is the better deal. People would be willing to pay even more for that 10-year bond, which would drive the interest rate on the 10-year bond down until they're equal. So that's the expectations hypothesis. It just says the 10-year rate is the expected 1-year rate over the next 10 years. Now, suppose that at a given time, like today, say, bond market participants are anticipating that a recession is about to come. And they know that one of the things that will happen in the next recession is that the Fed will try to fight the recession by lowering interest rates. The Fed will try to stimulate the economy. If we get into a recession, one thing you can bet on is the Fed is going to be lowering interest rates. And so if you think we're about to go into a recession, you think the Fed is going to be lowering interest rates, you might be willing to take those one-year bonds and the yield curve would be inverted. Now, if the market knows this and the Fed doesn't, that could be a signal. It could be a signal the market is expecting the Fed to cut rates more than the Fed is. Okay, so here again is the basic graph, the 10-year rate and the one-year rate. And so the argument is, if we follow just the one-year rate, the black line, you'll see there's a cycle. That another thing that happens before a lot of historical recessions is the Fed has been in an episode of raising the interest rate. The Fed basically controls the one-year interest rate. That's basically an outcome of the decision it makes each time it has a meeting. The long-term rate is influenced by some other factors that we'll be getting into. But basically what this graph shows is that prior to a lot of recessions, the Fed was raising interest rates, trying to slow the economy down, raising it a little bit more, trying to slow the economy down. Then we get to a point where, oops, the economy slowed down a whole lot more than we wanted. The Fed cuts the rates. And this particular interpretation of what the yield curve inversion is about says the market is ahead of the Fed in realizing where things are going to play out. That's one theory for why we see an inversion of the yield curve before a recession. The market's figured out the Fed's going to cut rates. The Fed hasn't. Turns out we get in the recession, the Fed does cut the rates, and that might be one explanation for why an inverted yield curve helps you predict an economic recession. Well, that's the story of the interest rate yield curve that you'd hear in the first class when we talk about this. The second class, we tell you, well, guess what? That expectations hypothesis is a nice theory, but it doesn't really fit the facts. And actually, you can see that just from the fact that on average, the 10-year rate historically for 60 years has usually been higher than the short rate. 60 years, the long rate being higher than the short rate. That's not because the market was expecting the Fed to raise the short rate. The market might be wrong now and then. They're not going to be wrong for 60 years. Something else is going on besides an expectation that the Fed is going to change the short-term interest rate when we see, as we usually do, the long-term yield higher than the one-year yield. And so in our second lecture on the term structure, we say, well, there's also a term premium. It may be there's some extra compensation you receive to holding a long-term bond beyond what you normally expect to get from a short-term bond. We call that a term premium, an extra compensation. Maybe investors are scared for some reason about holding long-term bonds. They know on average the long-term bond is going to give you something better, but they're worried about something bad happening when that long-term bond won't do so well. And because they're worried about something bad happening, there's a premium on the long-term yield. That's called the term premium. If you like, you can think of it as an insurance policy. So when you buy, say, fire insurance for your house, it's not because you expect your house to burn down. You're not betting on your house burning down. You're getting insurance because you know if your house burns down, you're really going to need the money then. You're going to want the money so much when your house burns down that you're willing to pay a premium. You're willing probably to spend all your life paying fire insurance and never collecting anything. That's the basic idea of a term premium, that maybe investors historically were willing to accept a lower yield on a one-year bond than on a 10-year bond because the 10-year bond was exposing them to some kind of risk that really scared them. On average, it's probably not going to happen, but the one thing that could make the long-term bond do poorly is the one case you really want to be insured against that. So we can talk about it as sort of this abstract concept. Actually measuring it is kind of straightforward. Measuring this thing I've defined to be the term premium is, in principle, a cut and dried task you could give an engineer. What do I mean by that? Well, if you build a model to predict what the one-year interest rate is going to be over each of the next 10 years, you could use that model to tell me, here's the average value I predict for the one-year bond over the next 10 years. I can look at the 10-year yield and see what average rate it's implying. And I can compare those two. I can compare my model prediction of an average of future short rates with what the long-term yield is, and I could say, well, the long-term yield is higher than that model's prediction, in which case I'd say there's a positive term premium. Or I might find the long-term yield is lower than that model prediction, in which case I'd say there's a negative term premium. So in principle, this concept of a term premium, this concept of the extra insurance that people are willing to pay for, the extra return I could have from a long-term bond, but I'm giving it up because there's something scary about the long-term bonds to me. In principle, it's something you can estimate. Now, I say in principle, because we all know the devil's in the details. So what exactly is your model for predicting interest rates? Well, different people might use different models. Let me just show you the predictions from a couple of models. Here's one that a lot of people use. It's a model developed by Adrian Crump and Mensch when they were working for the Federal Reserve Bank of New York. So some people call this the Federal Reserve Bank of New York model. And this is just a plot of their estimate of this thing I call the term premium. It's their estimate of this extra return you would expect on average if you buy a 10-year bond instead of a one-year bond. And I'm picking this example not because it's necessarily the best model anybody has out there, but it's the easiest one to get your hands on. They have at the Federal Reserve Bank of New York website, you can download every day this series for the term premium. And so people do, and that's part of why they've been a huge success. It's just so easy to get their data. By the way, this is one of my predictions for any of the young scholars here. If you develop something, make your data available. Make it easy, because it's been a real win-win model for these guys, letting the data go to everybody. Now, in their defense, they came up with a very, very fast way to estimate this, so it's no problem for them every day to give you the new estimate. But anyway, there's their model. And the thing I want you to notice about it is that term premium historically was a positive number. If you go back to the 1980s, it's a number 3 or 4%. People really, really were getting a higher return, according to this model, with a long-term bond instead of a short-term bond. But the striking thing, that number is actually negative today. According to this New York Fed model, the term premium today is negative. According to their model, you'd actually get more money on average if you buy that one-year bond rather than the 10-year. Now, that's just one model, and I want to emphasize again, these models are not perfect by any means. There's some other researchers who built different models to predict the one-year interest rate over the next 10 years. Here's, for example, one developed by Christensen, Diebold, and Rudebush. Christensen and Rudebush are at the Federal Reserve Bank of San Francisco, so some people call this the Federal Reserve Bank of San Francisco model. You can see it's a different number, a different model. They're coming up with a different estimate of this term premium. But the bottom line is kind of the same. Now, their series doesn't go back as far, but they're also saying, according to their model, that this term premium used to be positive. Today, it's negative. Well, if you're suspicious of both models, and personally I am, you might say, well, is there a way I can just look at the data, just the raw data? Don't give me any model, don't give me any assumptions, just show me the data. So that's what I'm going to do now. And I'm going to look at the answer to the question, suppose you bought a 10-year bond a year ago, and rather than hold it all the way to 10 years, you sold it today. You buy a 10-year bond, just hold it for 1 year and then sell it. Well, you might have some extra profit. If the price of that bond goes up, you get a capital gain. You might have some loss if the price goes down, but you'll have some kind of money at the end of a year. We call that the holding return. Return from a 10-year bond, buying it 1 year and holding it. Now, another thing you could have done a year ago is buy a 1-year bond. Get whatever interest rate you did on that. And excess holding yield is just the difference between those two interest rates. So this is just an after-the-fact summary. Were you better off? Would you have been better off a year ago if you bought the long term or the short term? If the holding yield is positive, you would have been better, knowing everything you know now, if a year ago you bought 10-year. If the excess return is negative, you would have been better off with a 1-year. And this is just a plot of that excess holding yield on 10-year bonds relative to 1-year bonds. I've taken a 5-year average to kind of smooth it out to get the big picture. And what is the big picture? That excess return is negative there in the end of the 1970s. Big negative. If you bought long-term bonds in 1978 and sold them a year later, you got slaughtered. What happened was, at that time, yes, the long-term bond was above the short-term bond, but we saw a big increase in inflation, a big increase in interest rates, so it wasn't enough above the short-term bond. You actually would have been better with the short-term bond if you'd known what was about to happen to inflation. Now, when you get into the 1980s, that excess holding yield becomes very positive. And it stayed positive for a long time. Basically what happened was investors got scared by that experience. They got burned by the inflation in the late 1970s. People with long-term bonds got burned. And it was a fire that hurt not just bonds, but every other investment. Stocks did badly. The inflation at that period was bad news for every investment. It was the kind of thing people wanted compensation for. It was the kind of thing you'd pay to get insurance against. And anyway, that's one interpretation of what's going on here. Once burned, twice shy. Long-term bondholders got slaughtered at the end of the 70s. Afterwards, they demanded a whole lot of extra compensation for long-term bonds, so they weren't exposed to that same risk. They weren't exposed to that same inflation risk. And what's been happening since then gradually come down. What we've seen gradually over time is that extra premium you get from long-term bonds over short-term bonds. Yeah, it was really big in the early 1980s. It hasn't become negative when I'm looking at 5-year averages like this, but it's a whole lot less consequential than it used to be. I could show you some other models of the term premium, other ways of going at it. Frankly, they all come to the same bottom line. They all come to the same bottom line. There was a big positive term premium in the 1980s. That premium has disappeared or maybe become negative today. What sense does that make in terms of this insurance theory of the term premium? Well, in the 1980s, inflation was the big worry. That was the thing that had wiped out so many investors. That was the one thing they really wanted to be insured against. And long-term bonds are going to do badly when inflation picks up. If you're going to have an asset that does badly in the one state of the world when you're going to want your money, you need extra compensation. That's one theory. That's my theory, personally, for why we had such a big positive term premium in the 1980s. Investors' big worry was inflation. They demanded a premium from any asset that was going to lose when inflation went up. That's not the world we live in 2019. The big worry on a lot of people's mind today is deflation. The big scare a lot of people have is that, well, we'll go into a global recession and we're not going to see inflation with that recession. We're going to see deflation. Long-term bonds are going to do great if we have deflation. And actually, long-term bonds give you extra protection today against the one thing that may be scaring a lot of investors. That could account for a negative term premium on long-term bonds today. If the big scare has gone from inflation to deflation, and I think to some degree it has, the term premium might have gone from positive to negative. And there's some evidence looking at the data a lot of different ways that it has. Now, what's that mean? Well, if in the 1980s the term premium was positive, and pretty much everybody agrees that it was, that means that on average in the 1980s, the long yield should be above the short. Not because people are expecting the short rate to go up, it's because they're worried about inflation. They're demanding a premium, demanding some extra return on any asset that's going to get slaughtered when inflation goes up. And in that environment, an inverted yield curve was a very unusual thing. In that environment, when usually the 10-year rate is 300 basis points above the 1 year, it's really remarkable if the 1 year starts to offer you a higher return. Now, if today the term premium is negative, then the usual thing we should be seeing is an inverted yield curve. If the term premium is negative, the new normal is the long rate is below the short rate. Why? Because that long rate is going to give you extra protection against the one thing people may be worried about in the current environment, namely deflation. Okay, well, let's look at the data another way. Now I'm going to just look at a pure forecasting exercise. I'm not going to try to predict interest rates. I'm going to try to predict GDP growth. Let me predict GDP growth over the next year on the basis of the current spread between the long and the short rate. When the long rate is way above the short rate, so we have the yield curve with the usual steep slope, I'm presumably going to predict faster GDP growth. That's a good sign. When the long rate is not much above the short rate or even below, I'm going to predict slower growth, maybe even negative growth in a recession. And I'm going to show you the results of that regression analysis using the 10 most recent years of data to estimate it. So I'm basically going to look at how that predictive relation has changed over time. At each point in time, I'm going to ask the question, if you looked at the yield curve on that date, what would it predict? If you looked at the spread on that date, what would it predict for what's going to happen to GDP growth over the next year? Okay, so here's the plot. This is a plot of that regression coefficient. Horizontal axis, we have time. Each date, I'm estimating a new regression at a new point in time because I've got just the 10 years of data through that date. The vertical axis here is the height of that coefficient. When that coefficient is high, it's saying when you see a big value for the spread, when you see the 10-year rate way above the 1-year rate, you predict real strong GDP growth. When you see a low value for the spread or a negative value for the spread, you predict negative GDP growth. And we're summarizing how that predictive relation changed over time. And what you see from this graph is that in the 1970s, the 1980s, this was a pretty reliable predictor. In the 1970s and 1980s, when you saw the yield spread was low, you should predict slower growth, maybe even a recession. But look at the more recent values. That's disappeared. It's frankly not something in the data anymore. Looking at the data this way, somebody tells you, gee, the yield curve is flat, the long rate's the same as the short. How does that change your forecast of GDP? Well, based on the recent data, doesn't change my forecast much at all. And, okay, so whatever this yield curve signifies, it's something different today from what it did historically. And this is one of the real challenges for economic forecasting. People say, why can't it be like the physicists, have some law? And the reason is the rules keep changing. The meaning of these data keep changing, and I'll say some more about that a little bit later. But what can we do? Well, what you can do is look at some other indicators. I've talked quite a bit about the yield curve. Are there other early indicators of recession? And what do those tell us? What kind of sign are those sending us right now? Well, here's the one that I personally think is the most reliable early signal of a recession based on long-term experience. It's the number of people who are filing for the first time for unemployment insurance. When you lose your job, you can file to receive some compensation. This is a count of the number of people who are saying, I want to start collecting unemployment insurance. And you can see the recessions here on this graph. And this doesn't give you a lot of advance warning. Sometimes it's just a few months. Sometimes it's really not until the recession starts. But what you see is a very steep climb up in new claims for unemployment when a recession begins. And you see it drop just as steeply as the end. This is one of the indicators, people who made the early call on the Great Recession in 2009 coming to an end. They looked at initial claims for unemployment in spring of 2009, said, guys, I know it's been tough, but it's going to get better. And people who looked at this indicator were right. Now, there's some reasons economically why it's a little bit more accurate early signal than just the unemployment rate. It turns out not everybody who's unemployed qualifies for unemployment compensation. But if you're fired or laid off, you are. And people getting laid off is one of the things that's happening in a recession, different from other times. And also, everybody who's eligible for unemployment insurance doesn't claim it. Not everybody who's eligible collects it. And it seems to be something, the people who collect know something about their circumstances. They know they might be unemployed for a while. Anyway, it's just in the data that new claims for unemployment are pretty good early signal. Okay, what do we see right now? Nothing. Those are near, again, an all-time low, the latest numbers. So what I conclude pretty confidently from this is that the U.S. is not in a recession right now. Could start soon, hasn't started yet. That's what I conclude from this. Here's another indicator. It's based on the number of Americans working, comes from a different data source. It's based on establishment surveys. And there's a fair bit of noise in that, month-to-month numbers. It's a little hard to get too overboard on what any 1 month's number signals. But here's a way I kind of find helpful to look at that data. It's the change over 2 years in the number of Americans working. And again, we've got the recessions indicated there as shaded regions. And it's something we see in the data that the momentum in employment growth starts to slow down before recession, and in fact starts to kind of steeply drop off a few months before a lot of the historical recessions. So that's another indicator you might look at. What do we see from that right now? Well, it's stabilized. It's certainly not on the way down, not in any clear way. So I draw the same conclusion from this series, frankly. Recession hasn't started yet. This is something that might have given us a little bit of an early signal of one, and it's not sending that signal yet. Here's another indicator that's popular to look at. It's based on a survey of purchasing managers, people who are operating the plant. And it's just a survey. They ask them questions like, are you hiring more people this month or less people than you did the month before? Do you have more orders this month or fewer orders this month than you did last month? And they just take those answers, and if as many people say things are better as say things are worse, this number comes in at 50. If more people say things are better than say it's worse, it comes in above 50. Average value of this series is above 50 because in a typical month, things are getting better. Typical month, more places are increasing hiring than decreasing hiring. And that's another indicator. And again, you can see that this is an indicator of recessions. When that goes below 50, when a majority of people responding to the survey say things are worse this month than last month, that's often an indicator of recession. Now, we just got a little negative signal on this in the very most recent data for this particular number. Not very negative, not very much below 50, a little below 50. The indicator, manufacturing is slowing down a little bit. That's a bit of a concern. Now, when people look statistically at this series, they've come up to the conclusion, well, it's really not a recession signal until it gets down to 45 or something like that. nowhere near that yet. But it is a concern. It is a concern. There is some sign here of weakness in manufacturing, and we maybe know the reason for that. It's related to some of these concerns about what's going on with the world trade situation affecting U.S. manufacturers. And frankly, those concerns are something you see driving news about the trade situation, something you see driving those long-term yields that we started off talking about. Here's one other indicator, kind of interesting. This is a plot of the price of oil in the United States, dollar price of oil in the United States, along with U.S. recessions. And here again is another pattern that people have noticed, that often before a recession, there's a big run-up in oil prices, which may have been an additional shock that was contributing to the recession, along with the possible role of the Federal Reserve that we mentioned and other factors. And these run-ups in oil price usually are something just out of the blue. There's a war in the Middle East or something like that. Nobody knew it was coming. Once it comes, the price goes shooting up. A lot of Americans find they're paying more for gasoline. They can't afford that. They're cutting back on other expenses. That may have been a factor, particularly sales of things like autos, that was contributing to some of the recessions. Anyway, what do we see right now? Not there. Right now, I mean, the newspapers have a bias. They want to give you bad news rather than good news. The good news is, oil has been kind of cheap. Gasoline is not the burden on a lot of households' budget that it was a while ago. This is actually another leading indicator that's actually sending a favorable sign. So what do I conclude from all this? Well, I agree with Yogi Berra, who said it's tough to make predictions, especially about the future. Or let me, if I may, tell a brief story from the Bible, the story of Jonah. Some of you may think the story of Jonah is about a whale. That was just a subplot. The real story of Jonah was about the town of Nineveh, which was an ancient city in what is now northwest Iraq. And God told Jonah, go to Nineveh and tell them the people are wicked and I'm going to destroy the whole city. And Jonah said to God, I don't want to do that. And God said, why not? And Jonah said, well, because like you say, these guys are wicked. If I go tell them they're wicked, they'll probably kill me. And God and Jonah had a discussion and some negotiation of this, which involved Jonah spending some time in the belly of some creature in the sea, in the end of which Jonah said, all right, I'll go to Nineveh, I'll tell him. And Jonah went to Nineveh and said, people of Nineveh, you're wicked. God is going to destroy this whole city. And the people of Nineveh said, no kidding. Maybe we better clean up our act. And they did. And then God said, well, because the people of Nineveh have repented from their wickedness, I'm not going to destroy the city after all. And Jonah said, well, now look what a fool you made of me. You made me go say you're going to destroy the city and you don't even do it. And God said, well, you just do what I tell you and I'll worry about how things end up. So the moral of that story is, if God tells the people of Nineveh that he's going to destroy the city and they believe it, it won't happen. Why am I telling you that story? Because I think there's something potentially similar in terms of recessions. And Bruce and I were talking about this a little before the talk, that in some ways a recession results in a series of mistakes, which if people knew the recession was coming, they wouldn't have made. Case in point, this behavior of interest rates that we talked about. We mentioned there's this tendency of the Fed to be increasing interest rates before the recession because they're trying to slow down the economy. Then the recession comes. They say, whoops, we went too far. Suppose God went to the Federal Reserve and said, people of the Fed, I'm about to destroy the economy with a recession. What would they say? They'd say, oh, no kidding. Well, maybe we better cut interest rates now before that happens. The point is, if somebody did have a foolproof prediction of recession, the next recession, and the Fed knew about it, they would change their behavior. Or if God went to the White House and said, look, this trade war is going to cause a big recession, destroy the economy, maybe the people of the White House would say, no kidding, well, we better try to change things so that that doesn't happen. Now, maybe I'm getting into controversy here, how the White House would react from a direct message from God. But there are lots of other examples of people in the private sector making decisions. A lot of us would have made a lot of decisions differently if we'd known the recession was coming. And that may be part of why it's just plain hard to predict a recession. Well, let me give you one final way of looking at this. So suppose you give up on every model, give up on every bit of data, just throw darts at a board. Just say, okay, I'm going to predict a recession, I feel gloomy today. Let's say you did that every month for the last 70 years. Every month you woke up and said, oh, I think there's going to be a recession sometime, the U.S. is going to be in a recession sometime over the next 12 months. Well, if you did that stupid prediction, 30% of the time you'd be right. 30% of the time over a given 12-month period, you're in at least part of a recession. And the reason is these things happen. You look at a 12-month period, it's not that unusual. In fact, if you looked at a 2-year period, same thing. Just say, I predict there's going to be a recession sometime within the next 2 years. 43% of the time you'd be right. That's not because it's getting more likely when you wait longer. There's no evidence of that in the data. That's because longer sample, you're more likely to see something happen. So even if I didn't know anything about anything, and I told you that I think a recession could well come in the next 2 years, I'd be right. Now, what do I take of the yield curve? Well, as I said, I think people go a little overboard with that. I don't think it's nearly as crisp a signal as it gets played out to be in the financial press, but I am concerned about it. I do think a rational, reasonable person would look at that yield curve and say, well, maybe that probably is a little higher than 30% over the next year, or higher than 43 over the next 2 years. I look at that PMI, I look at what's happening in manufacturing, I look at the trade situation, I'd say, well, I'm a little more concerned right now than I would be typically. So I don't have any trouble saying, yeah, maybe more likely than not, we might well be in a recession over the next 2 years. But the probability is nowhere near 100%. And my bottom line is I urge a bit of skepticism when you hear some of these pundits more confident in their crystal balls than I am in mine, than I'm in my crystal ball, when they tell you for sure there's going to be a recession over the next year or over the next 2 years. They might be right, but in my view, nobody knows that for sure. So, thank you very much.
Recession indicators, given that financial system imbalances were the cause for the last recession, can you comment on the use of financial systematic risk indicators with regard to the ability to predict recessions?
Okay, well, I was talking about one financial indicator here, the spread. A lot of people have looked at that, for example, the credit, the amount of debt relative to GDP, and they noticed that that had gone up quite a bit before the Great Recession and then came down. So some people are using that as an indicator. My own analysis with that kind of data is that there's a little bit, again, of ex post confirmation bias in that if you try to say ahead of time, credit is higher than it should be and it's going to come down, that's a much harder thing to call in terms of a real-time forecasting exercise. There are lots of examples in the United States and in history where you see a run-up in the debt to GDP ratio and you do not see a financial crisis. Absolutely, there were some issues with the financial crisis, the whole subprime mortgage lending problem that we weren't paying as much attention to as we should, and indeed, we're all looking at that a lot more actively now. I do not see, although the debt to GDP has recovered some, I do not see conditions today for a repeat of what happened in 2007. Does it rely on who? Policymakers. Well, I talked quite a bit about the Federal Reserve because that's their job, frankly. They are monitoring all of these data and many more to try to figure out, have they gone too far? Do they need to start cutting rates? Personally, I think there's some limits to what the Fed can do, and one of those limits is the information problem I talked about. Another limit is I talked about things like a war in the Middle East, which could produce a problem with oil prices. And insofar as those kind of developments contribute to this phenomenon of economic recession, I don't think you can reasonably blame policymakers for that. In general, I think that the president gets too much credit when the economy does well and too much blame when the economy does poorly. I do think in terms of the trade situation, that is an area where I think we should ask for more from our policymakers. That's my opinion about that.
How do changes in the labor market structure, in particular with the gig economy, maybe change how we might interpret some of these unemployment claims numbers or types of indicators?
Well, that's another example of Yogi Berra, right? The economy keeps changing, the gig economy. They're not going to show up in the establishment survey numbers that I talked about. Unemployment compensation is going to vary state to state, I guess, whether they would qualify for that. But there are indicators that. So, for example, the J.P. Morgan Chase Institute, with their by tracking credit card flows, is keeping an eye on that. I haven't seen any indicator from them that the gig economy is blowing up. In fact, it continues to seem to be one of the more vital, vibrant parts of the economy. But yeah, that's another source of data other than the ones I was talking about, that as the world keeps changing, we need to pay attention to.
This one is slightly related. You said that the challenge for economic forecasting is to look for new economic relationships. For instance, inverted yield curve might not be relevant anymore. What new normals do you think might also be interesting?
Well, I talked longer than I should have. I showed you a bunch of series. I could have shown you a lot more. Another interesting indicator, which came out essentially of that exercise, is a different spread between interest rates. The spread between a risky rate and a safe rate, for example, BAA bonds versus Treasury bonds, or commercial paper versus Treasury bills. And that was something we historically saw also often go up before a recession, that BAA rates would rise more than Treasury rates, and commercial paper rates would rise more than Treasury bill rates. And in fact, there are a couple of very famous, incredibly talented economists, Jim Stock and Mark Watson, who were trying to develop for National Bureau of Economic Research a better forecaster of recessions. And they came up with exactly that variable, with exactly the kind of exercise you were talking about. And they came up with a thing, they call it the experimental NBER recession prediction tool or something. And they were all set to go. This was in 1990. And that was one of these recessions I talked about. And their advanced indicator never went beep. The recession came and went. At the end of it, the indicator said, oh yeah, we just had a recession, but it never succeeded in their original mission of predicting the recession. And there are a couple of the smartest, most talented people. If anybody can do the exercise you just described, I would have handed it to Stock and Watson. I think they came out of that exercise with a little bit of humility, and I approach this with a little bit of humility. Yeah, I mean, the financial engineers, they all want to say, here, give me the data, give me AI, and I'll go at this, I'll find some relations. You can certainly find all kinds of relations in the historical data. You just got a dozen recessions here or so. You can find all kinds of variables which historically are going to fit the original facts. The question is, are you going to predict the next recession? Because, as I say, these relations keep on changing. And my approach is kind of the opposite direction. Rather than look for the killer app, the one indicator that's going to give the answer, I want to look at a variety of indicators. I want to look at what people were thinking about in the early 20th century, along with right now the gig economy and all the data we've got. Something that has passed the test of time, and something I understand. And so that led me to my approach, which maybe is a little unsatisfying, but says these things are pretty hard. Here's the overall impression I have right now. But great question. I don't want to take away from the ambition of any of you that say, well, that's my task, I can do that. Actually, that's how I decided to become an economist. When I was an undergraduate at Colorado College, I was thinking, well, gee, my professors don't really understand how the economy works. I can make a mark on the world. This would be much easier than trying to be a physicist. You have to be. And then I went to graduate school, and I found out, oh, this might be harder than it looks. But that time it was a sunk investment, so what could I do?
Do you think this means the Federal Reserve should still cut rates, given that realized inflation has indeed been low and people have deflationary worries?
Yeah, that's one success story for economists, and we should describe it. That, as I said, inflation was a real problem, caused a lot of harm in the 1970s, and we sort of figured that out. And for many of you in the room, I'm talking about maybe another planet wanted to talk about inflation. You didn't live through it. Because we did make some progress on that. And it's a matter of adapting, again, to these changing relations. Certainly when the Fed rose interest rates, started raising interest rates, they were worried that maybe we're getting behind the curve. Maybe inflation pressures are starting to pick up. And so far, we don't see that in the data. That's part of what's convinced them to back off a little bit now. That's the debate. That's why it's not an immediate call. You might say, well, why doesn't the Fed just cut rates all the way to zero, as apparently the president advised the Fed to do today? And the answer is, well, okay, there might be a recession. There also might be inflation coming back at some point. But that's another one of the difficult questions. But I think it is a success story that the Federal Reserve and most central banks around the world, inflation usually is not the main worry people have today.